Hi everyone, welcome. We're going to give a few minutes before we kick it off. We do have some poll questions for you. Let me. So, where do Americans store most of their wealth in 2026? The correct answer is individual stocks. 25% of you guys got that right. Second question, over the past 30 years, what has been the best performing asset class? The correct answer there is large US stocks, and it looks like you guys got all that right. So perfect. All right. I am Elena Leva, Marketing Coordinator at KWB Wealth, and I will be your host for our 2026 Mid-Year Economic Outlook. Kerry Bub, Quentin Bub, and Mike Razook are here to discuss America at 250, the history behind our growth, and where returns are coming next. Before we begin, take a moment to review the disclosures on the screen. This webinar is being recorded and will be available for replay if you'd like to rewatch it, send it to family, friends, or colleagues that you think could benefit. And then if you head to the resources button at the bottom of your screen, you'll also see the slide deck that's available to download, just in case you want to access it after this webinar. We'll also have time for a Q&A, so type your questions into the box below at any point during the webinar, and then we'll answer them at the very end. With that, I'll turn it over to Kerry to get us started.
All right. Thank you, Elena. Thank you for that introduction and appreciate all of you taking the time to be online with us today. As Elena said, this is our July 22nd, 2026 Economic Outlook. And we do have Mike Razook, who is an executive wealth manager and a longtime participant here on our team at KWB Wealth, and Quentin Bub, who is our chief operating officer and wealth manager as well. And we have a couple of notable events going on for those of you that have been paying attention maybe to the website and some emails. This year, KWB actually turned 30 years old. Yeah, I've been doing this for a little more than 39 years. Come February next year, it'll be 40. KWB started in 1996. And thank you for all of you that have been a partner, a client, a raving fan, and we really appreciate you all these years. We also have a birthday. Rachel Bub happens to be my daughter, and many of you know her, turned 32 today. I know I don't look that old, and she doesn't either, but we're having fun and we're having birthdays. And then, for all of us this year, and maybe you did it over July 4th, I would think you did, we've been celebrating another birthday. America turned 250 years and counting. And today, what I wanted to do in this economic outlook is change it up just a little bit. We spend a lot of time talking about current events and what happened in the markets the last 3 to 6 months and what we might anticipate the next 6 or 12 months. And we're going to do that. We're going to save that for the last 2/3 of this little presentation. But what I wanted to do today was kind of go back and look at maybe history and kind of like, how did America get here? And what does the future look like as we go from here? Not from a day-to-day thing, but I'm talking general, big picture. So I want you to close your eyes for a minute and think back to 1776. You're a colonist, you got a horse and a buggy, and you're living your life. And on July 4th, 1776, the colonial leaders in this country finally reached a point where they felt they could no longer reconcile with King George III and England. And thereby, they created and signed the Declaration of Independence. 11 years later, the colonial leaders created the Constitution of the United States of America, which actually took effect in 1789. And it was really these documents, and I would say the principles that were within them, that became the foundation of our government today. And to help me with this presentation, I kind of thought, well, where am I going to get some facts and figures and whatnot? So I do what a lot of college kids do today. I asked AI, artificial intelligence. And one of the biggest questions that I had that I wanted to share the answers with you is, what was the list of grievances against King George III and England? And there was a lot of reasons that were popping up, but the biggest reasons that I wanted to share with you is that he, the king, did not approve laws that were good for the people. In other words, it was the people for the government, not government for the people. And ironically, he made the military independent and superior to the civilians and civilian government. So basically what happened is if you didn't follow along with him and his ideals, he could send the militia to kind of persuade you to think otherwise. And you don't have to look far today in other countries where this is going on. It's going on in Venezuela. Cuba, Iran, and Russia. So after 250 years, we the people have really gone through a lot. And there are a lot of significant things that have happened. And one of the things I always find interesting is every time I meet with clients and each generation thinks, oh, Kerry, we've never gone through something like this before. And out of politeness with clients, I always try to, oh, yes, yes, you're right. But have you ever thought about this or that? And so today, what I wanted to share with you, a couple big things that we went through over the past 250 years that we seem to have gotten through. So if you bring up the slide as far as that, and I think looking back, at least for me, I think you have to be optimistic about America. You have to hope and believe that the citizens, the institutions, and the innovation capacity that we have will help us overcome the challenges and the disagreements we have. And, America has consistently been stronger than pessimism when it comes to solving the challenges. And we've never had the absence of problems. We will always have the absence of challenges, or we will always have challenges. But what we have the ability to do is to overcome them. So let's look at 1863. It was the Civil War. And you talk about a divisive country at the time. Here, we weren't just throwing words at one another. We were pointing weapons and guns and cannons, and families were fighting against families, brothers against brothers. For the whole decision was, should the United States remain as one nation? And should we abolish slavery or expand it? And during that time, over 600,000 Americans lost their lives, cities were destroyed, and for a while, the country's future was in doubt. But in the end, the United States remained as one nation. Slavery was abolished in 1865 through the 13th Amendment of the Constitution, and a stronger federal government relative to the states began to exist. And then if you go beyond that, you'll see the Great Depression, World War II, terrorist attack, 9/11, the final financial crisis. All these things were pretty significant. And then fast forward to 2020, COVID. It shut down most of the global economy almost overnight. And I remember here, March of 2020, we sent everybody home. I was working in my laundry room. I took my laptop. We had the ability to communicate. And one of the things good that we did at KWB is years prior to that, we had become aggressive in putting things in the cloud so that we could work from anywhere, gather information from any location. And that really helped us continue with, I would believe, uninterrupted service through that time. But, millions of people's lost their jobs, businesses closed, markets experienced one of the fastest declines in history. But at the same time, on the sideline, scientific innovation was moving forward. And we produced vaccines in record time. Businesses reinvented their operations. Markets recovered far faster than anybody believed possible. And yes, today we still face concerns about inflation. Interest rates, are they going higher or lower, especially if you're trying to buy a home? We have a lot of government debt. We have geopolitical conflicts. We have the issues going on in Iran. We have artificial intelligence. Is my job going to be replaced? And so these are real concerns and deserve thoughtful attention. So let's look at America's strengths. In other words, after 250 years, we seem to have overcome the challenges. But what are our strengths now that will help us maybe into the future? And for those of you that know much about real estate, one of the things they always say is, location, location, location. Most of us would agree that property on the coast in Newport Beach, California, is likely going to appreciate faster than maybe an acre or two out in the, desert in Apple Valley or Mojave or something like that. And that's certainly, I think, apparent here in America. First off, America is bordered by two vast oceans, which gives us a reduced risk of an invasion. We have two land neighbors, Canada to the north, Mexico to the south, and which neither really offer any military threat. Now, of course, we have to agree on trade and there's other challenges, but at least for the most part, we're peaceful with one another. We have extensive coastlines with numerous harbors supporting trade and naval power. We have fertile land, navigable rivers, especially the whole Mississippi system. We have abundant natural resources. And we lie between Asia on the west and Europe on the east, across the oceans, making US kind of a bridge or a center spot for global trade and military operations. We have strong property rights. If you build it and it works, you have the opportunity to create and keep wealth. You own the property, you patent the ideas. This motivates people. We have a democratic governance, a rule of law. Citizens have the ability to influence government through elections, to openly debate ideas, to protect individual rights, and to peacefully, hopefully, not always, challenge leadership. I mean, and the government works for the people, not the other way around. And I know the process is messy and it's imperfect, but it has provided stability over the long run, allowing the country to adapt to changing circumstances. We have an entrepreneurial culture. Take a look at Elon Musk. The guy is born in South Africa, moves to America, starts a little company or gets involved in PayPal, sells his interests, creates an electric motor or electric car company called Tesla, all the while building a SpaceX company that's launching rockets to the moon. And he happens to put satellites there that creates a system called Starlink, which allows people almost anywhere on the planet to have access to the internet. Well, why did he come here? It's probably because of the strong property rights, the individual freedoms America has created, and the environment for innovation. I was recently in Peru and I met an Australian, an Aussie. And one of the things he said to me is, Kerry, you just don't know how much advantages and how great things are in America compared to even Australia. Businesses improve productivity. Universities, researchers develop breakthrough technologies. Workers adapt to changing conditions. And in the end, capital flows to the best ideas. And over time, those ideas create wealth and better living standards for us. We're a free people, free markets. We get to do what we want to do. We get to work where we want. We get to live where we want. We get to buy what we want. And we have great abundance. I go to the grocery store here in America, it could be winter, and I can still buy fresh lettuce and avocados. When I go to Mexico, it's hard and difficult just to find really good fresh vegetables, even almost any time of the year. So some of those things we take it for granted. A recent example, if you guys watched the World Cup, was what some of the foreign attendees said about America. And a lot of them were really surprised about American hospitality. I mean, people were kind, willing to give directions to this or there. They were amazed by the size and the spectacle, of the stadiums. And then the regional diversity of the cities. Boston is so different than Fort Worth, Texas, or Dallas, or Los Angeles. And then just the food and everyday culture. And many people kind of remarked that this challenged some of the negative stereotypes that they had formed based on international news and social media. So, lastly, as we get near the information Mike and Quentin are going to share with us, is the USA a good long-term bet? And I say absolutely. A couple things that we have going for us first is we have abundance, great natural resources. We have oil, natural gas, coal, renewable energy, solar, geothermal, all kinds of different things. We have some of the world's most productive farmlands, forests, water, and mineral resources. We have geographical diversity, fertile plains, mountain ranges, deserts where we can go lettuce in the summertime or wintertime, sorry. And we have free markets. And a free market is based on the idea that competition and consumer choice drive the economy. America believes that free people, free markets, democratic institutions are capable of adapting, correcting the mistakes, 1865 13th Amendment that abolished slavery, and creating opportunities greater than the challenges of the moment. And that ability has helped evolve America as one of the greatest countries over the last 250 years. We have democratic institution, private investments. Historically, it's been proven that governments that own large portions of industry or centrally direct economic activity often experience slower innovation, fewer incentives, entrepreneurship, lower productivity, and reduced consumer choice. And it adds up in the numbers. The United States GDP is estimated to be about $30.5 trillion in 2026. The closest rival is China with about 19.5. But then you look at developed nations in Europe, Germany, about 4.9 trillion. Over in Asia, Japan at 4.4. So a smidgen of what the American economy has been able to produce. We have an innovative spirit. Innovations transform daily life, competition, private enterprise, allowing those willing to work and do the hard work, they get greater financial opportunities. And all the things that today we have, like the automobile, commercial aviation, the internet, AI, were all accelerated by businesses competing to solve problems and meet consumer demand. And if you're a company and you can make a product that people want and need, they will spend their money, and you have the capacity and the ability to create wealth and confidence for the future. Lastly, we also have a mixed economy. It's balancing between capitalism and social safety nets. And I would say definitely the US sits towards the capital end of the spectrum when you compare us to other European countries. But we're not purely a capitalistic system. We have a market driven economy with strong protections for private enterprise. We have government regulation to address market failures and protect the public. That's what happened after '08 and '09, and even after the Great Depression with the banking system. We have strong safety social networks, and that provides support in retirement, disability, unemployment, healthcare, low income assistance. And yes, generally we do that at a lower level than many European countries. And I think that's really the debate going forward. So when I kind of sum this up, I would say the current balance of capitalism today in America and the social safety nets reflect the majority's past preferences. But I think going forward, this will be the subject of public and political debate. Americans, quite simply, have differing views on the appropriate roles of markets and government. But what makes America great is we have the ability to debate, to innovate, and correct those mistakes. And just one final quote here, Warren Buffett says, never bet against America. And I second that. So that's kind of my history lesson, why I think maybe as we start looking at the next couple of slides and Mike, jumps in, is that, you know, and this is going to be validated in a couple of the slides that we're going to go through in a few minutes, is that, we live in a land of abundance. Be proud, be happy. It's not perfect, but, my travels around the world, I can honestly say, I don't know of any place that I'd rather live than here in America. So, Mike, after my monologue there, why don't you take it away?
Thank you, Kerry. I'm fired up. I feel like I'm blessed every day that I can wake up and, just be in America. So, yeah, I appreciate the history and your perspective. So, Jay, why don't we pull up a chart? I was asked to come up with where has the return been coming from this year in 2026? And I think what's nice about it is it feels like it's coming from different places. When we kind of look back over the last several years, it seems like the Mag 7 was capturing the headlines. It was always these 7 companies that were driving all the growth, all the return of the stock market. And what this is showing us is on the far left, we can see where the S&P started out. It was 6846 at the beginning of the year. Today we're sitting around 7,500, and you can see each component of the Mag 7. Did they add value? Did they actually lose money this year? And so we've seen some pretty big rotation. We've seen Microsoft drop about 25% this year. We saw Meta go through a pretty tough time. Tesla has, actually taken away points from the S&P 500. And really, out of the 7 companies, Apple and Google are the only ones that really have driven some return this year. But the big story, the other 493 stocks in the S&P 500 have been driving the majority of the return. And so it's nice to see that diversification effect. And it's one of the reasons why, we always advocate that people don't concentrate, stay broadly diversified, and just, believe that over time, we're going to have lots of different things that do well. So 493 stocks have added 609 points to the S&P 500 this year. And it's been a good story for diversification again in 2026.
And Mike, doesn't that fall into my comment about innovation? When you look at the list of these companies, Microsoft, Meta, Tesla, Amazon, NVIDIA, Apple, and Google, a lot of these companies weren't even around 50 years ago. A lot of them weren't even around 25 years ago or so. And you talk about innovation, all of these companies making products that make our life better. Could you imagine if we didn't have cell phones today and Google Maps and, and all those things? Life would really be a challenge. So innovation is clearly showing up in the marketplace here.
Yeah, and I think too there is a lot of hype around the Mag 7. Like sometimes we get portfolios from other clients if they're coming over, like they might be invested in all of these. And then we had clients that are concerned about, hey, what happens if these companies just like trip and fall, right? What's going to happen? And we can see here that, hey, they haven't really, some of them, Microsoft has a pretty good tumble and things are still pretty good. That not everything weighs on these 7 companies.
Yeah, I know that was always a big debate. If something was to happen to these 7 companies, is there just going to be this massive sell-off in the rest of the markets? And I think what's been nice is maybe some money has come out of these companies, but it's gone to other ones. It hasn't gone to the sideline. It hasn't moved to bonds or to cash. People are confident about other companies adding value. So it's been nice to see a little bit of a rotation here. Jay, let's go ahead. Let's change to the next chart, because what I like about this is it's showing us a little bit of a window into the future. Unfortunately, I don't know where the best place to put our money is going to be for the remainder of the year or for next year. But what this is showing us is what the market thinks and expects for the best performing sector of the S&P 500 for 2026 and into the next year. And so what this is showing us is on the far left, actually, sorry guys, this was looking at the best performance. Skipped a chart here, but this is showing us where the sectors have done the best for the S&P 500. And so when we look, energy has actually been the best performing index. And it makes sense when you guys think about it, right? We had the Strait of Hormuz closed. We had oil prices spike with the conflict with Iran. And so oil got dramatically more expensive, and that really benefited companies like Chevron and Exxon. They've done phenomenal this year. And, the next best performing asset class has been industrials, and then tech has been number 3. And so when we look at that Mag 7 and, really that sector as a whole, it's not been the best performing asset class in 2026. So we've got that sector rotation. We've got some benefit from other things this year, and it's nice to see. When we look at the yellow on this chart, it's showing basically like the peak to trough decline that we've seen in different parts of the economy. So if we look at the S&P 500 right there in the middle, it's up about 10% for the year. But we've experienced about a 9% drawdown. That happened right after the conflict with Iran was announced, and we saw stocks sell off, pretty much through the beginning of March into the middle of April. And so we've had, just under a 10% drawdown, not even correction territory yet. But energy prices have come down. We've seen a 15% decline, peak to trough in energy stocks. So in other words, at one point, they were up almost 35%. And so far, the only one that's really had a tough time has been discretionary sector. So that's going to be like big ticket items, autos. You'll see it with like appliances, things like that. But, the good news again is it's not very concentrated in just one area. We've got lots of sectors that are doing well and actually beating the broad market this year.
Yeah, and I just think it's so much healthier for the market to not have one leadership all the time. Back in the days, it was the Nifty 50, then it became the Mag 7. And that just sets us up ultimately for, bad results. So I'm very excited to see other parts of the market starting to do well. And I always ask, yeah, AI is going to benefit, right? We got new spending going, incredibly into AI, but who benefits the most? Is it us, KWB, implementing AI to help us do, meetings and different things more effectively? And that helps us become more profitable and efficient and whatnot. And I think that helps a lot of other companies as well. So it's exciting to see this thing broaden out and not be so concentrated in tech.
It also shows us that it's a very normal year, even though, Kerry, you mentioned earlier that, hey, this time, through history, we've had these moments where, no, this time it's different. And I've heard that a little bit too this year with what's been happening. But even with the this time's different kind of thought process, what we see here is this is actually very normal. When we're halfway through the year, we see corrections of 10% on average year over year, and we actually haven't even hit that point. We're just shy of it.
Right.
What I like about this too is it shows people just don't know. I mean, I remember coming into 2026 and, the headline was, oh, this is going to be the year for healthcare stocks. Well, you look at them and they're the 4th worst performing sector of this year. So, the reality is nobody knows, so it's nice to just own everything, be diversified, as we mentioned. And yeah, I think that it's just normal for there to be volatility. So let's go ahead to the next chart. This is one that I gave a little preface of because, if you asked me, where's the best place going to be to put our money going forward? Obviously, nobody knows. I just gave that example with healthcare stocks. But what this is showing is what the market expects and where the opportunity is going forward according to the market. So what this is showing us is what are people willing to pay for $1 worth of earnings in the various sectors of the economy. So the winner here is industrials. So in other words, investors are willing to pay $26 for $1 of earnings within the industrial sector. And so what this is showing is people are very optimistic about data center build outs, infrastructure spending, things like that, where, we still think that there's opportunity. The S&P itself, the gray bar there in the middle, is trading at 20 times earnings. And so it's a little bit higher price than maybe historic averages, but it's still kind of trading in that realm of 20 times earnings. So again, people are willing to pay $20 for every earnings of companies. And the interesting one here is we just saw in the previous chart, energy was actually the best performing sector, but looking forward, people are only willing to pay 12 times earnings. And so, in other words, people expect energy prices to normalize. The market thinks that we're going to see oil become, less expensive. So hopefully we get back down in the 70s, maybe the 60s in terms of Brent crude prices. And so, yeah, I feel like this is just showing us where the market thinks we're going to see opportunity over the next year or so.
And it continues to make your diversification argument, because if you look there, you mentioned energy, but discretionary was at the bottom of the chart. It's one of the worst areas, and now it's like one of the next to industrials, one of the next best places that they think money is going to be moving to.
Right. Yeah, and you wonder about energy with all the noise and news about energy and oil prices. Why are people willing to pay less for those future earnings? And one of the things I remember reading a few years back was maybe we're at peak oil. In other words, global demand isn't rising anymore because all of a sudden we have, geothermal, we have we have wind, we have hydro, and we have all these other sources. And simultaneously, cars are getting more efficient, appliances are getting more efficient. We have LED lights instead of the old incandescent. So it's kind of an interesting world, and it's hard to predict. And staying diversified does help with those volatile things that you can't predict. And I think certainly, America's going to continue to innovate, and it'll be interesting to see what happens here. And just so you guys know, industrials, when we speak of industrials, we're thinking of things like Caterpillar, John Deere, big companies that are, really doing infrastructure construction and whatnot.
Yeah, and I think what's fun about what Quentin was saying too is I always remind people, it's like if you don't like something in your portfolio, give it a year. It's like don't just sell it and try to chase the winners and losers, because if you just give it some time, you're going to get this rotation, and the things that did the worst are probably going to become the best. Energy was a dog for many years. People just didn't want to own oil companies. But when you have oil shocks, it's the thing that kind of saves your bacon. Right. So, the last thing that I'll point out on that chart was I was mentioning how the S&P 500 is a little bit overvalued historically. Normally the market's traded about 16 and a half times earnings. And you can kind of see that little 10-year average dot there on the chart. It's been trading historically around 19 over the last 10 years. So what's kind of happened is the average price that investors are willing to pay has gone up over time. And I think it makes sense when we go back to the context of the Mag 7. These were companies, again, that people are willing to pay 30 or 40 times earnings for because they've been delivering the earnings. And so I think that what's kind of happened here is the average price to earnings ratio of the S&P 500 has actually been driven up by those big companies becoming such a big part of that index. So in other words, in my opinion, I think that higher prices might be, a new normal. So let's go to the next chart, Jay, because I think it exemplifies a little bit of a Goldilocks situation that we see for investors this year. So what this is showing is what has really driven the return of the S&P 500. I said that it's up about 10% since the start of the year. And what's neat is most of that has been driven by earnings. And that's what we like to see. We like to see companies more profitable. We like to see them doing well on their balance sheets. And what's really interesting about this year is multiples have gone down. So, if we look back like last year, the market was getting a little bit expensive. It was trading at 25 times earnings. And usually when that happens, we're due for a little bit of a correction. And we got that. The tariff tantrum that we saw last year did cause markets to have a fairly strong sell-off. And I think what's been cool is people have been willing to pay less. So we've seen the stock market go up despite the fact that multiples have gone down, and it's been driven by earnings. And we like to see that. We like to see cheaper markets.
And that earnings is what pulled us out of that rough patch back in March. As
Yeah.
we, you know, yeah.
And it's always interesting, when you talk to people as far as like, well, how do you feel? And well, hey, Kerry, the news is terrible and it's all negative and I don't know what we're going to do. And I'm worried about this and that. But hey, let's go to Disneyland. Let's go buy the new car. So what's happening is while the news is negative, people continue to live their lives and they continue to travel, they continue to do things. That's what's helping the earnings. Also, corporations realize that they have to be profitable. So what they do is they invest in their infrastructure, they invest in their systems, just like we do here every day, trying to figure out how can we do better, how can we do it with less. I don't want to say less people, but as efficiently as we possibly can. And that's why capitalism and innovation is just such a big impact on why you should probably be bullish on America again over the long run.
Yeah, I think the good thing about earnings is it's kind of the wake up call to the market. What tends to happen is you get some kind of event, whether it's tariffs, it's wars, you get an emotional reaction and people sell off. The stock market, it is an emotional beast. It's not always logical, but earnings tend to be that logical component. When people start to see the numbers come in and they're positive, they can't help but become optimistic again and buy. So I
Right.
think that that's really helped the market, recover pretty quickly, even though we've had pretty big oil shock this year.
Mhm.
So let's transition to the next one, Jay. So this is now showing us regionally where has return been coming from. And, I think it's a story kind of continuing a little bit from last year for emerging markets. We could see that they're actually one of the best performing asset classes this year in terms of regions. But I think what's neat this year too is developed international companies, US companies, and Europe are all neck and neck. So we saw pretty large outperformance in those other two last year with the S&P kind of trailing international stocks. I think in 2025, the S&P was only up a measly 18%, but international companies are up 35, and we saw emerging markets up almost 37%. And so this story is kind of changing. Maybe the outperformance is starting to, level a little bit here. And personally, I think a lot of that excess return of 2025 wasn't necessarily these companies being better and having better earnings. It was the currency weakening of the US dollar. And that actually benefited and boosted the earnings and returns of international companies. So I think that headline might be, stabilizing at this point, and we're seeing the dollar level.
Yeah,
And
and I
just
think,
going,
oh, go ahead,
go ahead.
Quentin.
Well, again, the diversification. I, remember coming in here and having clients sit down with us and, all right, show me how much money I've lost. And I'm like, okay, knowing kind of what was going to happen next, like showing their portfolio. And we actually got to have a different conversation than what they were expecting, and even than what we've had before, because for a while, internationals, they're always they were lagging and underperforming. And then when you come in, you see that, hey, yeah, the US market might be down a little bit or flat, but your internationals are up, and that's helped your portfolio year to date. Again, just continues that argument for being diversified. And while, yes, we are long-term optimistic about the US, there's times to be pro international and emerging markets as well.
Yeah, and I think what happened when you look over the last 15 years, the US has outperformed international markets substantially. And I'm always kind of a contrarian. I think, well, reversion to the mean. Eventually, these companies are going to catch up and whatnot. And maybe they had a little bit of that last year. But as I did this research for this talk today, part of it, I think, is just, gosh, at the end of the day, America is just so much more innovative. The drive for the entrepreneurialism just makes America probably a better long-term bet than a lot of other alt choices. Now, that being said, I would not invest in international stocks because things could certainly change. And prudently, you have to be diversified. But it's kind of amazing the American exceptionalism that we've kind of seen, at least when it comes to products, innovation, technology, and those kinds of things.
Yeah, I think what's fun about looking at international indexes is so we saw the Mag 7 are the biggest component of US markets. You guys know what the biggest stock is in international indexes?
Siemens?
Nestle.
Oh, I was okay. That
Yeah,
was
so
my
not
second
not
guess.
not a
Yeah.
lot. Yeah, not a lot of innovation in hot
Mhm.
chocolate these days.
Right, right,
Yeah,
right.
but I think that's just what's different is those indexes have a lot more of those value companies, and that's why we've seen a lot of outperformance in U.S. markets. It is much more innovative and tech focused. So let's go to the next chart, Jay, because this is going to show now all asset classes, and we could see what's been the best performer and what's been the worst. And so I think what's been unique about this year is small caps, actually the best performer. And if we go back, small companies have really underperformed for almost 15 years now. They've almost been a source of frustration because it just feels like the Russell 2000, which small cap index, has been stuck at 2,200 for as long as I can remember. I mean, it literally has been there for almost 10 years. And so you had very little return in that asset space for a very long period of time. And so just this year, they're up 22%. And then again, the second best performing is those emerging markets. So it's nice to see that diversification effect and lots of things of added value, commodities, mid caps, even real estate. And then really the losers this year have actually been gold and Bitcoin. So gold we've seen have an exceptional run. I think it even got all the way up to about 5,500 and then, it dropped almost back down to 4,000 relatively quick. So it's definitely another reason why we feel like it's just good to be spread out, own lots of different things, and hold them for long periods of time.
For sure. And one of the things I think it's like the dynamics of the market is changing. So this whole small cap thing is kind of interesting because years ago, Apple came about in 1975, I think, and went public in 1979-ish. I think they raised about 100 million. Today, you look at companies like SpaceX and others, what they're doing is they're not going public nearly as quickly because of all this private equity, private investors that are buying into these companies, providing the capital so that they don't have to go public and meet all these regulatory requirements. So I think one of the other things that's happened why small caps haven't been as good is there just hasn't been as many great companies coming public. They're waiting.
Mhm.
And, like SpaceX, they come public, they're worth $1 trillion or more, and all of a sudden they're in the S&P. There was no time, a chance for the average investor like us to buy SpaceX, back when it started.
Yeah, it used to be a company would go public, they would be a small company and work their way up to a mid cap, and then eventually they'd be in the S&P 500.
Right.
And now, like you said, you've got companies that are just skipping. So they're entering the S&P 500 as soon as they go public.
Right.
So it's definitely been a big change in that dynamic. And I think I heard a commentator joke and basically say it seems like the small cap index has been a place for large companies to die instead of for new companies to enter the public markets.
Right. Yeah, they start out, well, they are large like Blockbuster or whatever, then they get small and then they go away, like, the Sears and the Kodaks and whatnot. So, all
Yeah.
right, we're going to go to the last slide. Or Quentin, you're up.
All right. So I have been tasked with the next wave of growth here and where we think things are where we're going to see some momentum maybe coming from. And the first thing we just want to talk about, which Kerry just briefed us on a little bit, is uh, SpaceX, for example, and what that IPO has meant. So just a few weeks ago, SpaceX went public. It's the largest IPO in history, and it's also a different IPO than what we have seen before. The structure of it's different, the makeup of it's different. But that being said, it still raised 75 billion and allowed SpaceX at a point, it's no longer there now today if you look, but it was at 2 trillion valuation at one spot at one point in time. So this kind of it's a good marker for where we are at in this cycle. I mean, for years now, we haven't had any big companies, any large IPOs, anything that was notable until SpaceX kind of entered here. What we are seeing though is a broad participation. It's not just like, we are seeing AI, aerospace, defense, some industrials, energy infrastructure, the different areas of kind of what drives our growth and our economy are all coming to the table saying, hey, at this point, maybe we do want to go public. So we might see some other companies do that this year. And Jay, if you bring up the first chart here, it's going to show us, where we were. So 26, you can see like 2016 up to 2021, there was some flat times, some growth. 2021 was a big year. There was a lot more speculation in 2021. If you can remember back to SPACs and some of those things that were happening, we also were sitting on a bunch of cash from, the stimulus checks and things that went out. So that was why 2021 kind of spiked. Then after that, we had rising interest rates, which make it harder for companies to get cash and be able to invest and do things. We also saw some things around government and just allowing, making it more difficult for companies to go public. And 2026, with the time this chart was produced, SpaceX had not gone public yet. So we were expecting that, we'd be somewhere over 250 billion in funds raised from initial public offerings, these companies going public. And what we see here is that actually now we're at 141 billion raised. So we're pretty close to where we were in 2021. And we still have some other IPOs potentially knocking on the door. We got Anthropic, OpenAI, and a few other companies that are again, those are two AI companies. There's actually like a company that does kind of like online billing and stuff like that that's potentially going to go public this year. So there's potential for things to be happening and have a pretty solid year this year.
Yeah, it's good to go back and, I mean, just think about 2021. I mean, there was just so much capital poured into the system. Like you said, everybody was getting stimulus checks and, we're investing in stuff like drunken sailors. So to have almost the same level of capital raised this year is pretty impressive. And I look back and probably a lot of that was just pent up demand. Back in 2022, we had interest rates spike, and then we had the Wrath of Khan, not to be confused with Star Trek. Lena Khan was head of the FTC and was just very protectionist, no M&A, no mergers. And so a lot of companies held off going public and just kept the private markets during that time.
Yeah. And we need more companies going public because over the years, through acquisitions, there's been fewer publicly traded companies. And then also because of private equity, there have been fewer companies coming public. And, that means that a lot of people don't necessarily have the opportunity to participate in other ventures. It's like you probably drive around, you see all these car washes, right? Well, how do you participate in that? What we're seeing is venture capital is buying all these things and then eventually maybe taking them public or whatnot. So I think, the fact that there are more companies coming to the market is healthy and good and great for our investors and the economy.
Yeah, so that's kind of where we're at this year. I know Kerry gave us the history of kind of like the last 250 years of America and all of that.
And I did that in 10 minutes, 12
I'm not
minutes.
going to tell you I'm not going to tell you what the next 250 years looks like.
Dang.
But I'll tell you what maybe the next 5 years looks like here to give you an idea. So behind all of kind of what's going on here, we have a big AI infrastructure build out coming ahead of us. And the hyperscalers, Microsoft, Amazon, Google, Meta, they're on track to spend about 700 billion this year alone on the things that are kind of shown here on the chart. So compute, data centers, and power. And you can see the growth in that from now until 2031. So compute is like the chips and the servers and that kind of stuff that goes inside of these large infrastructure data centers that we're building. And then, power has been the big thing in the news when it comes to AI. Like, how are we going to create the energy to produce these? What is it going to mean for the grid? Some companies are taking that on themselves. Some are working with the local municipalities to build that out. But this is the trajectory and what we've seen committed by these large companies to go ahead and build out what they see as the next wave of the future in AI. And, you know, the thing to note here is that it's not just a 1 year story. This isn't just 2025 or 2026. Like these companies are committed to this. They see growth here and they are experiencing that as they report earnings and stuff and those things. Um, they're committed to this build out. And so we actually did have a large portion of our GDP driven by AI and its development in 2025. And that's good for the economy. Sometimes we're not going to have just all consumer spending. We need other pieces to drive that growth and provide jobs. And this AI build out is going to be one of those things that does that.
So Mike, go ahead and give me that question that you asked me the other day. How
Yeah.
many,
So how
and
many people globally do you think, like what percentage of the global population is paying for an AI subscription at the moment?
so I answered that question the other day and I said, well, 2%. I didn't think many people were paying for it.
Yeah, it's
And the
actually
real answer is,
half
yeah,
a percent,
0.5%.
right?
Yeah. And so as people adopt AI and want it as far as to help them with their business, the things that they're questioning or concerned about, I think it's a pretty big opportunity going forward. Yeah.
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 Yeah, and
All right.
and what we've seen too, just real quick in the workforce is there's always been a concern of how this is going to impact jobs. We have seen layoffs due to AI. Some companies are reporting that yes, it is due to AI, but we're also seeing a restructuring. So it's not just, hey, people are losing their jobs and companies are cutting. They're actually adding jobs in areas like AI security and build out. So they're, repositioning things. And the companies that are using AI, so the 0.5% or whoever's doing it, those companies are actually growing and they're hiring more people compared to the companies that are not using AI
Yeah.
at all.
So I just want to sum this up, and we didn't do a real big slide on this, but it's like I think at the end of the day for us at KWB Wealth, it's hard for us to be pessimistic about the near term future. I don't see signs of a recession. It seems the jobs being created are still positive. Interest rates likely to stay stable. I don't see them going down anytime soon. I don't see them going up anytime soon. I think the consumer confidence is still there. The markets aren't cheap, I would say that, but earnings seem to continue to grow and expectations are still very positive. So I would say at this point, bar something happening in Iran or something else, at least the things that we do see, we don't see really big, significant reason for concern. Now, that worries me because I always like to worry. So right now, I don't really have much to worry about except not having much to worry about. So, Mike and Quentin, if you got any other thoughts, and then let's go to questions.
Yeah, I would say, just one final thought on what Quentin was saying with AI. We've definitely been adopting it at KWB, but we don't want to replace the human experience and the element of, people calling us and talking to a live person. So I feel like the businesses, the people who use it to enhance their productivity are going to be catapulted far ahead of other people. But I think that people are hungry for that human experience and interaction. And I don't think that that's something that's going to go away.
Yeah, we're
Or-
trying to do things where we can use AI to help us with those tasks that are kind of just the slog of the work, right? And that will allow us to be able to spend more time with our clients and listening and getting to know them better and what's important to them. That's where we've really started to implement these tools. So I do have a question here. How often are portfolios rebalanced? Is it based on the various market performances?
Mike?
Well, I think it depends if we're talking about IRA money or if it's non-IRA money. So what we would call non-retirement money. Non-retirement, we tend to do it maybe annually, and we only do it when things are really, really far out of whack. And so, we try to have a target weighting. If somebody comes to us and says, I want to be 60% stock, and then stocks outperform bonds, Eventually, they might become 65 or 70%. So we do like to take those opportunities to rebalance, try to get back to our target weightings if things have gotten far out of hand. We're hesitant to do it because sometimes it does create tax liability for a client. So that's why I break it down into two different categories. But for IRA money, a lot of times we're able to be more nimble. We're doing rebalances in some of our models on a quarterly basis. Sometimes it might be annually, but I'd say on average, it's about once a year. And we're looking again at a target goal for stocks and trying to stay within like a 3 to 4% band of those targets.
Yeah, and we're also leaning on some large institutions to help us with our research and our asset allocation. So we could actually, we have some models that are much more short-term, momentum driven, and you might see you own gold and other things that are really in the, positive momentum cycle. And then we have other companies that we use, like we have a model called long-term, long horizon that is more looking for value and just isn't quite as, I guess, active. And so usually what we try to do is we blend different strategies within these portfolios because, truthfully, we don't know which strategy is going to be the best in the end. And that's why we constantly meet with clients to kind of evaluate that. Steve and Ricky, our research team, constantly looking at our partners and making sure that we have the best partners because we're independent, we're unbiased. We just want to do the very best thing we can do. And so when we do trade, we're not getting income or generating commissions. It's because we think we have a better idea to help the portfolios grow.
All right, I've got another one here. The hyperscalers have started to issue debt and their cash on hand has dwindled. Uh, is this debt issuance the start of something more serious with regards to the AI build out? Are we looking at something like what happened with fiber optics in 2000s? The first thing I would say here, and then Kerry or Mike, if you have comments, but that's why partially we're seeing some of these initial public offerings, is that's another method of raising capital in order to go continue building these things out. And if people are, if they have to do, things like they can't just go like, oh, we want to go public today and they go raise money. They have to do the road show and there's different things that have to happen. And they get serious inquiries and interest before that happens. And I think that's, one, they've waited longer, but two, as OpenAI and maybe Anthropic decide to go public here, there's real interest in the retail investor in owning those companies and even other larger institutions. So there's reason there that they can go public and people are going to buy them. And that's just one method other than debt issuance for them to be able to generate that capital.
Yeah, and maybe there are concerns long term. Are we going to overinvest in this AI stuff? It still seems to be pretty early. But as a part-time farmer, I'm growing avocado trees, and it takes 5 to 7 years for avocado trees really to produce fruit. But at some point in time early on, you got to make a decision. Do I plant 100 trees or 1,000 trees? Because you don't know what's really going to happen down the road if Mexico and whatnot. But you have to have staying power and you have to have the ability to invest and be patient. And it appears here we've got some great companies, and I think we're way too early in the stage for cycle to say maybe we're over investing. It just seems like this is something the whole world can use. Companies, people, individuals. It just seems like we're still in the infant stage of this.
Yeah, I think too, the cash that these companies had was enormous. I mean, their stockpiles were absolutely massive. And I think what they were doing previously was stock buybacks. We're just going to buy our own stock. We're going to try to reduce outstanding shares. And it was like they were waiting for something to invest in. And I feel like this has been it. They've been deploying their cash because they feel like it's going to yield them long-term results. And sometimes for a company, it is cheaper to borrow than it is to go and issue more shares. It's been contradictory for them to issue more shares when they've been wanting to do buybacks of stock. So I think a little bit of it is just that dynamic. And these companies are so large that their debt issuance is relatively cheap. They're not needing to get mortgage rates like individual investors at 7 to 10%, they're able to get cash relatively cheap in like the 3 to 4%. And if they're able to, get returns of 30 or 40%, they'll continue to borrow. So I don't feel like it's equivalent to the 2000s in that regard, but I think that they're finally just seeing something that they want to invest in. And I feel like the CEOs of these companies are incredibly impressive. They've been able to navigate COVID, they've been able to navigate trade wars, tariffs, oil crises. They've been thrown a lot in just like a 5 to 10 year
Yeah,
period.
for
And they've
sure.
been able to keep these companies nimble, dynamic, and resilient. And so I feel they know what they're doing.
All right, we got two more questions, then we can. So here, are you concerned about the political resistance to data centers regarding environmental impact? I think this one,
NIMBY, NIMBY,
yeah. Yeah,
not in my backyard, right?
right.
Yeah, go ahead, Quentin. I'm sorry.
Well, I just to some regard this adds slowness to the process.
Mhm.
So the other question is like, hey, are we going to overdo it? And this is going to kind of be one of those things that is always going to be a battle and will probably add some resistance to the build out that will make it slower. So, and then we'll move around and see which areas they want it. There's some states that are like all open for it, some that aren't. Uh, and some are going to make it easier, some are going to make it harder. But that'll, again, kind of answer the other question, help maybe on that side.
Right. Yeah, I think it's kind of like a check and balance. It's like throwing some cold water on the hot fire. It's not all bad. Let's do this methodically. There are impacts to, in California, we already have high utility rates. If somebody comes in here and builds all these data centers and they need more power and we only have so much power in the grid system, who ends up paying higher electric bills? And California, we're already the highest in the nation, I think. So I think it's good. It throws a little cold water on the fire. Doesn't mean it's going to go out, but it is good that it kind of keeps it in check.
Yeah, I think it's a little bit of a learning curve because, these data centers initially were going to use up lots of energy, drive up local prices of energy. And so people were saying, oh, I don't want that. I don't want data centers nearby if my energy prices are going to go up. And so I feel like it's created conversations. Now you've got data centers and these companies that are saying, well, we'll build our own power plants,
Mhm.
and then we'll actually make it cheaper for residents to have energy because we'll give them energy at discounted rates if they do let us build data centers near them. So I feel like it's created a conversation that might actually end up putting everybody in a better spot. And so it is good to see a little bit of a pause and a little bit of pushback. That's always healthy.
Right. And I think that's what this whole American thing, right, is, right? We can have a debate. If we were in Venezuela or some other countries, well, we're going to build it there, there, and there, and there. That's what they do in China. So because of our democracy and our system, we get to have these conversations and try to figure out what's the right answer. And history tells us that generally we find it. So democracy at work.
All right, and then the last one here. So I asked Google AI the same question 3 times, got 3 similar but different answers. Are you fact checking your AI results to ensure they align with your personal views? So I thought we'd answer this one because Kerry mentioned at the beginning that he used AI to help him figure out, King George and the grievances. And I think here, so as COO, we take it seriously here, training people and our staff on using AI and making sure that you double check what the output is. And Kerry has always invested in this company and technology and stuff. He's not been one that, hey, no, we're going to hoard profits and not do something. And because of that, we've said, okay, we're going to open the doors. We're going to try different things. So we try ChatGPT or Claude and Perplexity, and we experiment to see what is the answers coming from these tools. And there have been times where when you ask it a question, it gets it wrong. So we are paying attention to that. And we also train our employees to make sure, hey, just because AI says it doesn't mean that's the right answer. It might be correct, and sometimes it is very good, but there are times when it's not. And so, we try to make sure that we are paying attention to that. And we also train our employees to make sure, hey, just because AI says it doesn't mean that's the right answer. It might be correct, and sometimes it is very good, but there are times when it's not. And so, we try to make sure that we are paying attention to that. And we also train our employees to make sure, hey, just because AI says it doesn't mean that's the right answer. It might be correct, and sometimes it is very good, but there are times when it's not. And so there still has to be a human element in this, which is why, we still have 21 something employees here, even though we're using some of these tools. And probably down the road, we'll need more bodies in the building, just as we continue growing and using this stuff.
Well, I try to remind our team too that when it comes down to exploring and building your knowledge, don't just go and find the answer, because part of the experience, the learning really happens with the process. Go
Mhm.
do some actual research, read some articles, learn the concept. And if you just skip to the answer, you're not really going to grow. You're not going to learn. So we use it, I feel, to check things that we probably 90% know the answer to. We might use it for a little bit of design. We might use it for, just a quick, hey, what's the contribution limit, this year? So just things that have pretty clear answers. But, we don't want to skip deep thought and research to just skip to an answer.
So you're telling me it was King Edward and not King George III?
I feel like it's going to get historic things fairly right,
Fairly right.
but when
Okay.
you're asking it complex things, that's when
Right.
you got to really dig into it and make sure that
Hmm.
it's correct. Yeah.
Right. Right. Elena, you want to close this up?
Sure, thanks, Gary. If we didn't answer your question today or you want to schedule an appointment, feel free to contact us with the information on the screen. Lastly, when this webinar ends, a survey will automatically open up on your phone or your computer. If you guys can just take 2 minutes to submit feedback, we'd really appreciate it. We host these events to be a resource for our clients and our community. And we want to know what you enjoy and what you think we can do better. So thank you all for joining and talk to you soon.